He didn't invent a new HVAC trick, he ran his service truck like a capital allocator, and that mindset made him a millionaire. In the next 10 minutes, you'll see how Evan, a broke installer with a $900 van payment, built a residential and light commercial HVAC company to $4.2 million in revenue, and how he almost lost it all on one can't-miss contract. The stakes weren't abstract. His name was on personal guarantees, his techs needed paychecks Friday, and a lawsuit letter showed up when his cash balance was under $6,000. The mystery is this: what single rule change turned his worst year into a compounding machine, even while competitors kept racing to the bottom? Evan started in 2011 in suburban Phoenix, riding shotgun with an older tech, hauling furnaces through attics in 115-degree heat. He was good with gauges, terrible with money. Every raise disappeared into rent and a used diesel truck he didn't need. When the shop he worked for got bought and the new owner cut hours, Evan took weekend calls on his own, charging $89 because that's what the guy on Craigslist charged. You already know how that ends, right? On paper he was busy. In reality he was financing customers, buying parts on a credit card, waiting weeks to get paid, and burning nights rewriting invoices because he didn't track anything. Then one Tuesday at a supply house, a gray-haired contractor named Dale watched Evan argue over a $22 capacitor return. Dale said, "You're fighting for pennies because you don't know your numbers." That sentence bothered Evan for weeks. Dale wasn't an MBA. He ran a 12-truck HVAC operation in the 90s, sold it, and now treated time like inventory. He showed Evan a legal pad with 3 columns: cash in, cash out, cash on hand. "If you don't watch this weekly," Dale said, "your business will watch you." Evan went home, opened a spreadsheet, and realized he was charging $89 for work that cost him $97 after fuel, parts runs, and callbacks. That's when he made his first operator decision. He stopped selling repairs and started selling outcomes: cold air today, no surprises, and a 1-year workmanship warranty in writing. But the move that actually changed his life was even smaller. He raised his diagnostic fee to $129, wrote 3 flat-rate packages, and required payment on-site through a card reader. No more they mail the check. Could a $40 price jump really matter? Within a month, his close rate dropped, but his bank balance climbed. Fewer tire kickers, fewer midnight texts, and enough margin to buy a second-hand recovery machine instead of renting. Evan also did something most techs refuse to do: he asked for reviews like it was part of the job. After every call he'd send a link and a 1-sentence prompt. "If I earned it, say it." By 2014 he had 125-star reviews, a wrap on the van, and a maintenance plan he called the Filter Club: $19 a month, 2 tune-ups, priority scheduling. It wasn't sexy, but did revenue stay predictable? The club hit 300 members, then 700. And that's when Evan got tempted by the kind of growth that looks smart on Instagram and kills you in the ledger. A regional property manager offered him a simple deal: replace rooftop units across 8 strip malls. Total contract value, $980,000. Evan had never touched anything that big, but the purchase orders looked like a lottery ticket. He bid it at 22% gross margin, assuming he could run crews non-stop and make it up on volume. He even hired a friend, Kyle, as a partner, 50/50ths, because Kyle knew commercial. What could go wrong with a handshake and a dream? 3 weeks in, the first shipment of units got delayed, then the second. Crew Saturday. Rent on the warehouse still hit. Payroll still hit. And Kyle started handling vendor payments that Evan never saw. By month 2, Evan's line of credit was maxed at $150,000. Then the worst call came from the city inspector: one mall's gas line had been tied in wrong and the entire row was shut down. No explosion, but a red tag is enough to stop everything. The property manager backcharged Evan for tenant losses, and their attorney threatened to name him personally. Evan's insurance carrier reserved rights, which is the polite way of saying, we might not cover this. Evan did the math at 2 a.m. He owed vendors $212,000, payroll tax was late, and Kyle's vendor payments included $38,000 to a company Kyle owned. Betrayal doesn't always look dramatic. Does it look like a normal invoice? Evan fired Kyle, but that didn't erase the contract. The lender wanted a plan in 72 hours or they'd freeze his account. This is where most contractors either fold or start lying to themselves. Evan chose a third option. He started treating every job like an investment memo, expected profit, worst-case loss, and how fast he could get his cash back. First, he called the property manager and offered a painful concession. He would finish only the units already on site, at cost, if they dropped the tenant loss claim. He also agreed to an independent inspection on every gas tie-in. It felt like surrender, but it bought time. Second, he walked into the bank with a one-page forecast and asked for an interest-only period. The banker said no, until Evan offered to place all receivables into a lockbox and send weekly job costing reports. Systems saved him when hustle couldn't. Then he rebuilt the company from the inside. He set a hard pricing floor, no bid under 35% gross margin, period, and every install required a 50% deposit before equipment got ordered. Customers complained. Evan didn't. He also stopped promoting the loudest tech and started promoting the calmest one. His new lead, Tasha, documented every install in photos, pushed checklists, and didn't tolerate shortcuts. Would you rather be liked or be profitable? Evan cut the strip mall project down, sold the warehouse lease, and went back to what fed him: service, maintenance, and small replacements where mistakes were containable. By 2018, the business was stable again, $1.6 million revenue, 18% net profit, and 900 maintenance members. Evan could finally breathe. That's when he made the second investor-style move. He bought back his own time. He hired a dispatcher before he could afford it, at $52,000 a year, and put every call into Jobber with a simple rule: no same-day service without a premium fee. Was speed the product? He also built a weekly dashboard, booked jobs, average ticket, labor efficiency, and cash on hand. If the cash number dipped below 6 weeks of payroll, hiring froze automatically. For sales, Evan went narrow. Instead of chasing every homeowner, he targeted dental offices and small medical buildings, places that hate downtime and pay for reliability. He offered a no-surprise maintenance agreement with guaranteed response times, billed monthly by ACH. He tracked lifetime value like it was gold. A $450 service call could turn into $8,000 in replacements over 5 years, so he stopped obsessing over the cheapest lead source and started obsessing over keeping clients. By 2022, his mix was 60% recurring contracts, 40% replacements. When supply chains got weird again, he wasn't stuck with giant fixed-price jobs. He had pricing power. In 2025, Evan paid himself $220,000, the company cleared $610,000 in profit, and he used that cash the way Dale taught him, not on toys, but on assets that would spit out more cash. He bought the building his shop leased, with a tenant upstairs. He rolled profits into a second service area and acquired a 2-truck competitor whose owner was tired. Evan didn't scale by motivation, he scaled by buying predictable earnings. Revenue is vanity, cash is oxygen. By early 2026, between equity, the building, and retained earnings, his net worth crossed $1.3 million. But the part Evan is proud of isn't the number. It's that the business no longer needs a hero. So what was the one rule change that flipped the story? It was deposits. Evan stopped being the bank for customers who didn't respect timelines. And there's a deeper point: when you're on the tools, it feels like risk is unavoidable. But once you track downside, you can design jobs where the worst case is annoying, not fatal. Isn't that what we all want? More upside with less sleeplessness. The job isn't finished until the money is collected. Here are the takeaways Evan built into policy, not willpower. Takeaway number 1, price for your worst week, not your best week. Set a margin floor and refuse volume deals. Takeaway number 2, collect deposits before ordering equipment. If a client can't pay, they can't play. Takeaway number 3, stop hiring the skills. Hire attitudes, promote the checklist person, fire the shortcut artist fast. Takeaway number 4, sell recurring maintenance first. One membership list beats 1,000 random leads. Takeaway number 5, run a weekly cash meeting. 6 weeks of payroll in reserve is your shock absorber. Takeaway number 6, make speed and certainty premium add-ons. The calendar is a pricing lever. Pick one policy and install it Monday. If you're running a truck right now, ask yourself, where are you acting like the bank, and where are you acting like the owner? If this breakdown helped, hit like, subscribe, and share it with one person who needs a cleaner playbook. This is Work Boots to Wealth, and we'll keep turning hard trades into smart money.